Hello, welcome to Any Answers Answered for May 2020. Sadly, we are still recording at home, of course, with the lockdown. I trust this video finds you all as well as possible and dealing with this particular situation. Of course, many of you still posting questions on Any Answers, and as usual, Tim and I have chosen a couple to have a closer look at. The first of them is from Band Manadar, and their question relates to the employer's national insurance when it comes to the job retention scheme and what have you, and the interaction with the employment allowance. Now, the question here is, they did not claim employer's national insurance as thought the employer's allowance had been set up to use that, so put 0 on the first claim. Can they now add that employer's national insurance to their second claim when they do the May payroll and the May job retention claim? Tim, it's an area that an awful lot of people are talking about, and it really is quite controversial.
It is. The basic point is that under the CJRS, the job retention scheme, the government or HMRC will pay as part of the grant an amount representing the secondary class 1 liability that the employer is incurring in respect of payments to furloughed employees. But that's the key point. The employer must have incurred that secondary class 1 for it to go into the overall calculation. And if that secondary class 1 has been covered by the £4,000 employment allowance because the employer submitted their EPS, employment payment summary, promptly and claimed the £4,000 employment allowance for this year, then you can't expect the government to pay you as part of the grant an amount that you yourself haven't paid. And so the answer is that you won't get the benefit of the employment allowance and the benefit of the CJRS payment in respect to that secondary class 1, both at the same time. But it opens up a far wider question, which one or two of the posters on Any Answers have raised, which is, what if at the time you submit the grant claim under the CJRS, you have not yet claimed the employment allowance? And it may well be that an employer did not realise that they had to make a claim for 2020-21 to get the employment allowance by filing an EPS, because in earlier years it was rolled forward automatically. Well, if they haven't claimed it, then the payroll should trigger secondary class 1 liabilities on the furloughed employees. That amount can then go into the calculation for the CJRS grant. So they do then get that reimbursed, or the appropriate amount of it reimbursed, under the CJRS. If subsequently, later in the tax year, they file an EPS claiming the employment allowance, then the £4,000 could indeed be used against secondary liabilities later in the year. And I don't think there's anything wrong with that. I think we're looking at two different government schemes: the employment allowance giving a handout, if you like, of up to £4,000 a year for secondary class 1, but also the CJRS covering an amount of secondary class 1 for furloughed employees. And there's nothing to stop them both applying. What we can't do is expect them both to apply on the same payment.
And of course, speaking to a couple of people recently about this, they were in a situation where they'd heard that there was some possibility of claiming later in the year and wasn't this attractive to them. But in fact, they decided to continue to pay full wages to the people that they were furloughing. And as a result of that, were going to have an element of national insurance that they still had to pay themselves. And bearing in mind, they were saying that cash was extremely tight in their business. For some people, we need to do the maths and decide whether actually it might be better to claim that $4,000 anyway to cover the additional charges, as well as losing part on the retention scheme, in order to make sure that the cash management is there. There's an awful lot of things to think about. The second question we have for this particular month is from John Stone, who has a question inevitably on the capital gains tax regime relating to the new 30-day payment and filing and what have you rules. John's question is, a couple have sold their former home in March 2020 after letting it for 2 years. Once the 18-month concession is brought into account, says John, the remaining gain is covered by the 2 annual exemptions of the couple. Is it necessary to complete the capital gains tax pages in their 1920 tax return So, of course, this actually predates the rules. I'm sorry for the 30-day point. This is the old rules. And the question is, do we need to include this information on the CGT pages when it's covered by the annual exemption?
Well, it is interesting. There are only two answers have been posted to this particular question, which maybe isn't that surprising because, as you say, it relates to transactions before the change to the capital gains tax regime for disposals of residential property. And for 1920, and of course, many won't yet have turned to filing 2020 tax returns, but for the tax year 1920, the old rules, if you like, apply. You've sold a residential property. The gain is indeed partly taxable, as the original post says. I'm just having a look at it. And as you said in your introduction, they'd let it for 2 years and having moved out. So they've got the last 18 months, but they've still got 6 months. And that gives rise to some gain. I'm interested, though, that the letting exemption didn't cover that, but we're not told about that. So the gain does arise. There is a small amount of chargeable gain on this disposal, but it's covered by the annual exemption for each of them. Now, it continues to be the case that where you have chargeable disposals that are covered by the annual exemption, you do not have to file them on your self-assessment return unless the proceeds exceed 4 times the annual exemption. So if the proceeds of the property exceed, for 1920, 48,000, the capital gains exemption was 12,000, 4 times that, 48. Double that, 96,000 for the couple, but 48,000 each. Well, if the proceeds exceeded that amount, they do need to file it on their 1920 tax return, but if the proceeds were within that, they don't. But of course, it's all change for 2021, and if instead of exchanging in March 2020, they had exchanged and completed in the new tax year, then they would need to consider the new UK land tax return regime, modelled on the NRCGT, non-resident CGT regime that came in April 2015, and there is in this case a capital gain. It's covered by their annual exemption. Well, in fact, because there's no tax payable, they won't be required to file the new UK land tax return within 30 days of completion, but they will still be required to put the details on the 2021 tax return, assuming that the proceeds exceeded the 4 times the new threshold is 12,300, so we're just over 50 grand each.
So while the new regime requires that 30-day filing, or rather, sorry, doesn't require that 30-day filing, it's not that we just ignore the capital gains when we get to the self-assessment pages later in the year. We will end up reporting twice in certain situations. And as you were saying, sometimes you'll only have to file once, but have to consider it for both returns. Okay, well, hopefully useful, hopefully covered the points there that people were interested in. Do keep posting on Any Answers, do keep well, and perhaps next month we'll be looking at your question on Any Answers Answered. But for this time, bye-bye.